I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, gold expert, renowned gold expert, James Turk, also a best-selling author. James Turk, thank you for joining us today on USAWatchdog.com.
Thanks, Greg. It's always great to be with you.
Well, last week people were clamoring to hear more about gold, and I said, wait, I had on Chris Martinson, who was great. But we didn't talk about gold, but I'm saving that for you, and I can't tell you how many times just recently, and all the times I've been covering this fevered pitch and this warning that they're going to run out of physical gold. We're going to be left with just mining production. The record sales of silver eagles, they shut it down at the U.S. Mint. They're near record sales of gold eagles. I think they filled 10,000 ounces in 2 days. Just high demand. Rob Kirby, who's a gold expert, derivative expert, says that demand for tonnage is ferocious around the world, and I'm hearing that they're going to run out of gold, and this could be the black swan event that starts tanking the markets. What say you about how low they're getting on physical supplies, not paper gold, physical supplies?
Yeah, understood. There are two markets. There's the paper gold market and the physical gold market, and they intersect at a price level. The problem is that there are two different types of things. Physical gold doesn't have counterparty risk, and paper gold, you're dependent on someone's promise to deliver gold to you at some future date. Now, I look at a number of different things, but for me the most important thing is the relationship between the spot price of gold and a distant price of gold, 1 or 2 months forward. And normally that should be trading in what's called contango. The future price should be higher than the spot price because of the cost of money. That's what's implied from the higher price in the future. But in fact, what we're seeing, and we have been seeing this actually, Greg, for since January 2013, more or less, more often than not, and again, we're seeing it at a deep backwardation, the spot price is higher than the future price. This is an abnormal condition, and it suggests a couple of things. First of all, that people would rather own physical than paper gold. And the second thing is that it basically confirms what the other anecdotal evidence is that's out there, that inventories are being run down, and that eventually the people who are sitting on the gold price are going to have to let go, just like they did when the London gold pool collapsed in March of 1968, and you're going to see a massive increase in the price of gold.
Do you think this is definitely signaling coming soon, that there's going to be a big spike? And could you explain that a little more? How does the big spike in gold happen?
Well, it happens when eventually somebody goes with their paper gold and says, I want physical gold, and the guy who promised to deliver physical gold can't find the physical gold to deliver, or the firm collapses. It's basically the result of what's historically has been called fractional reserve banking, but technically it would be fractional reserve bullion banking. You make promises that you can't fulfill because you don't have the inventory on hand to deliver against those promises. But, you were talking a little bit about price, when it's going to happen. It's always difficult to predict, but you have to look at value. And it's also probably worthwhile to look at seasonal patterns from time to time. Nothing always works all of the time. But you do get seasonal patterns in gold. And often you see the low in the summer months, July and August. Then you have a rally going to higher prices into the first quarter of the following year. So in terms of the setup, gold looks like it's going to be rallying from here into the autumn and into the winter months. That's a typical pattern, and I think I would expect that, particularly given how undervalued gold is at the moment, and all of the negative sentiment we're seeing out there suggests that people aren't paying attention to what's going on in the world.
And you think that this gold non-delivery, them running out of physical gold to make these contracts or to satisfy the heavy demand, you're saying that's going to spike up the price of gold and spike it up in a hurry?
Yeah, it will, because people will realize finally that all of these promises to deliver paper gold cannot possibly be fulfilled. At the COMEX right now, just as an example of one indication, there's 127 ounces promised for every 1 ounce that's actually in inventory ready to deliver. So, COMEX won't default, I don't expect, because they'll probably close the exchange down before that were to happen. But it's an indication of how much paper is out there relative to the amount of physical. And what it comes down to, Greg, you have to ask yourself, why are you buying gold? Are you buying it because it's a safe haven, doesn't have counterparty risk, it's money outside the banking system? Or are you buying to try to trade by profiting from fluctuations in the gold price, either going up or going down? if you're a trader, and I only recommend this for the professional guys, trade the paper gold market. But if you're an individual looking to protect yourself from an uncertain future, you want to own physical gold. You want the real product. You want something that doesn't have counterparty risk. And that's the thing that's going to become increasingly important, particularly as we see problems in the financial system continue to unravel.
And before we get to the problems of the financial system, because there are many, I want to talk to you about a few of them. Dr. Paul Craig Roberts says, hey, listen, this is fraudulent. And basically, I'll sum up his premise is that you have dwindling supplies, physical supplies. You have rising price demand, and you have sinking prices. And you can't have dwindling supplies, rising demand, and sinking prices. You can't have that. It's fraudulent. And so that, to me, if people are buying it knowing, listen, the big hands know it's manipulated. Let's just get that out of the way. It's manipulated.
Yes.
And if the big hands know it's manipulated, and they don't care if they're manipulating the price down, all they want to do is get their medal, is that a big tell that something wicked is coming?
Yeah, it definitely is a big tell. And all of these little pieces of evidence are important to basically make some conclusions that gold is extremely undervalued here and that there is going to be an adjustment. We're going to get rid of this backwardation we're seeing in gold. We're going to see a lot of these promises to deliver gold being broken. And ultimately, the only way you're going to resolve this is with a much higher gold price.
Well, and when you say much higher, what's much higher? I mean, just in the near term. If it breaks, how much can it move in a day or in a week or a few weeks?
Well, if you go back and look at history, it can move almost anywhere in a day or a week or even a month. But you got to be looking back to the old-time highs of 1900, 2000. We're eventually going to take those out. It's just a question of when we do it. And it's obvious that it's going to happen because gold has been money for 5,000 years, and ultimately people come back to gold when they realize that all of these promises of the banking system and the central bankers are really basically cannot be fulfilled. So, it's just a question of when that reconciliation comes. In March 1968, the dam broke and the gold price was released and it's climbed for another 12 years. When it finally gets released, the gold price gets released again this time around, it's going to climb for many, many more years. It's hard to say how high it can go, but relative to the amount of paper that's out there, both in terms of the quantity of dollars and promises to deliver physical metal, a price several times higher than what we are today is very, very reasonable in the long run.
What do you say to people that say, well, we're going to have deflation first, and then interest rates will rise, and gold will it'll be $300 an ounce. I think Harry Dent, who's a smart guy, I'm not giving him, he's been right since 2011 that gold was going to, come down, much to the chagrin of many.
Yeah.
Also, other people are talking about big deflation. Even my guest, Chris Martin, said we're going to get deflation first, and then inflation, later. But what do you think about that idea that we're going to get some pretty heavy deflation, i.e. the canary in the coal mine is Puerto Rico just recently defaulted on their debt, and actually the rating company said this is a default, which trips these credit default swaps. What do you say about that scenario, about deflation and gold price getting hit in a deflationary environment, at least at the beginning?
Yeah, we have to look at what deflation truly is. A lot of people use that term incorrectly these days. Deflation is a decrease in the quantity of money. And there is no decrease in the quantity of money anywhere in the world. Central banks continue to print. They continue to expand money supplies. When you look at Puerto Rico, or you look at Greece in the banking system, what happened there, you have a destruction of assets. That's not deflation. That's destruction of capital. That's an entirely different thing. You can have a destruction of capital and an increase in the quantity of money. And that's exactly what we have going today. I mean, if you look at prices of cost of living, medical expenses, pharmaceutical expenses, most food expenses, property taxes, things of this nature. What's going down in costs these days? Very little. The only thing that's gone down to a certain extent is crude oil prices, and that's showed up a little bit in the pump. But that's only a part of every person's everyday expenses. So I don't see deflation, and central banks have said we're not going to get deflation. They're always going to do QE of some sort or another to put more money into the system. So to me, yes, we're going to have destruction of capital as promises cannot be fulfilled, like we are seeing now in Puerto Rico, but we're also going to see higher gold prices because of too much money printing and too much quantitative easing and things of that nature.
Well, what about the collateral? I mean, what I've said is that, we've been told, this is my only quote I've ever invented, we've been told debt is money and debt is an asset. Federal Reserve notes, money, and debt, bonds are an asset. But isn't it going to come down to collateral? Aren't people not going to trust the assets, the bonds, as collateral, and people are going to look for other collateral, like land or gold or diamonds or artwork? Isn't it going to come down to collateral?
Yeah, that's actually a very good point, because money, or what's called money today, these paper currencies that we use and bank deposits that we use, they're only as good as the assets supporting these liabilities circulating as currency. You have money deposited in a bank. That's a liability of the bank to you to make good on that money. Now, you have to look at bank assets. And look at, recently there was reported in Italy, as an example, 17% of the bank assets, loan assets in Italy are non-performing loans. That basically, and half of those are insolvency situations. So you have to question, well, what good is the deposit currency sitting in the Italian banks if the loans themselves are never going to be repaid? Because it's much greater than the amount of equity in that banking system. So you're absolutely right in focusing on the collateral backing these money substitutes that are circulating in place of gold. Gold is the true money because it doesn't have counterparty risk. That's the key.
What are your rich? I know you're around people who buy gold. I mean, you got Von Greyer's is around people who buy gold. What are your rich contacts saying? What are they? Are they fearful? Are they saying they're buying gold and they're not going to stop until they get every dollar out of the bank? I mean, what are your rich contacts saying? What are your inside sources saying?
Yeah, basically, it's interesting because there's a common thing, and you don't have to be rich. That's the interesting thing about it, to be buying gold. But the common theme is that I've acquired a certain amount of wealth. The future is uncertain. I want to make sure that me and my family are protected, come what may. So I'm going to buy some physical metal, put it aside, and hope that the system continues to work, and that I'll be able to run my factory or my business, or my bank's not going to collapse. But just in case, because of all of the problems that we're seeing in the world and all the problems that we're trying to deal with, I want to have this gold put away safe and sound and secure, maybe in 2 or 3 different places around the world even, so that you have the opportunity to internationalize and go global with your assets, because you want that protection. You want to be able to say, gosh, I can sleep well at night because come what may, I know I've got this little nest egg of gold that's been around for 5,000 years, and it's going to see me through tough times if tough times come again.
Well, if you take a look at what's going around the world, I mean, the defaults in Puerto Rico. Now you have, the situation in Greece far from settled. There's people that are they're going to be in open revolt before the end of the year. They're just squeezing the heck out of them. It doesn't look like the system is going to get better. They've been trying this, beating this dead horse in QE and QE1 and QE2 and twist, and who knows what they're going to have next. But they've been doing this, and it's not getting better. It's obviously not getting better. Could this thing all come apart this fall? A lot of people, even the gold people, are saying this fall is going to be tough. They're thinking they're going to run out of physical metal this fall, which is going to be a big, ugly black swan when they're going to go, oops, the real money is gone. Do you think that we're heading for something sooner than later?
Yeah, I think it could be this fall. In fact, it's something that I've been focusing on. And there are geopolitical events that are causing that. One of the key geopolitical events is the rebalancing of the special drawing right, the IMF's currency. China wants to be included. If China's excluded from that, it may go its own way, and that's going to have real implications for the international monetary system.
And you think that this realignment, the IMF has been warning that they want to give more rights to the developing nations, that'd be BRICS nations, that'd be China, that they are going to bring it into the SDR, which doesn't that mean that the value of the dollar has to devalue? I mean, isn't that going to be a pretty big hit to the buying power of the dollar? Or what do you think about this? Yeah,
at the end of the day, it all comes down to supply and demand. We don't normally talk about the supply and demand of money, but we have to factor that because it's also affected by the supply and demand. The purchasing power of the currency will go up or down depending what happens in the relationship between supply and demand. Occasionally we talk about supply. The Fed releases M1 and M2. That's the quantity of dollars in circulation. Demand cannot really be measured. It can only be measured in terms of relative exchange rates. And what we're seeing is that with all of the problems in Europe, the demand for the dollar has gone up. The exchange rate to the euro, the dollar has appreciated and the euro has fallen. So that's an indication that you're seeing this demand for the dollar. But this is a temporary knee-jerk emotional reaction. People aren't moving to the dollar because it's any better than the euro. Both of the currencies have serious problems, maybe different types of problems, but they're serious problems nonetheless. And ultimately, when we run out of currency alternatives, you're ultimately going to go back into the precious metals, and you're going to have a reordering of the international monetary system, and inevitably, we're always going to go back to gold. We've tried it so many times in the past, but ultimately, you go back to gold.
When people say reorder the monetary system and reset the monetary system, what does that look like to the guy on the street when we get this reordering or this reset? And I'm not being mean to you. I'm just thinking to boil it down to what is it going to look like to somebody in St. Louis, Missouri who says, wow, they just reordered the financial system.
Yeah. Well, if you're going to see other currencies competing with the dollar for global trade, and we're already seeing that with the Chinese yuan, as becoming increasingly popular for doing trade transactions. That means that people will start using the yuan instead of the dollar. That means the demand for the dollar goes down. If the demand for something goes down, the value of it goes down as well. And when you're talking about money, that means the purchasing power of money goes down. The other way of saying it is that inflation goes up or the cost of goods and services go up. So if demand drops, it's not going to be good for the dollar. And it appears that, after this little fluke is over with the money coming in from Europe that's brought the dollar to its current level and has also put pressure to a certain extent on gold prices, you're going to see the money go the other way. And where it's going to go, my guess it's going to be in the precious metals. In fact, if you look at gold in terms of euros, gold is actually up this year.
Wow. Gold is up in terms of euros. And you think that we could run into a situation where either COMEX or it gets out that that physical supplies are gone. They're waiting on people to dig it out of the ground and smelt it and put it into a coin or a bar. I mean, we're going to get down to there's no above ground supplies. You think that's coming soon?
Yeah, I think you're going to see that fairly soon because of the pressures that we're seeing in the London market, which I follow very, very closely, which is predominantly a physical market, less so a paper market. And it's ultimately coming down to, people recognizing that, gosh, because of the problems we see around the world, I really want the real thing. I want the physical metal. I'm not going to take some paper promise.
But explain the pressures in that London market. Why are you saying that, things that we're going to hit a situation where we're going to have a no delivery, that people are going to just say we don't have it? Why do you say that when you watch the London market?
Because of the difference between the spot price of gold and the paper price of gold. And this is the point I was making before about they're two different markets. They tend to intersect, but as the paper market moves away from the spot price, that's when you're ultimately going to say, okay, well, everybody's going to exit the paper market and stay with the physical side of the market. And that's this backwardation situation that we've had in London now for over 2 years, since they announced QE3 back in December 2012, January 2013.
And you're saying that the spot price being higher than the future price it's getting to the end of what it can do.
Yeah, look at it this way. The spot price is always lower than the future price. In theory, it's not supposed to be, and gold is not supposed to be in backwardation because gold is not like other commodities. All of the gold that's been mined throughout history still exists in this above ground stock. The amount of oil that's produced, the amount of grain that's produced, we only basically produce enough for what we need for the immediate future. But gold, everything that's been produced throughout history still exists. It doesn't disappear. It doesn't get consumed. So gold gets accumulated this way because it's money. And because it's money, the spot price is always going to be lower than the futures price. The only times that it hasn't happened in recent history are a couple days in 1999 when that was a low, back in 2008 at that low for a couple of days. But now we've had it happening since 2013. Where more often than not, gold is in backwardation. So we have an extremely unusual situation, which is basically shouting that, yes, gold is extremely undervalued. And if you believe that gold's 5,000 years of history as money does not end today, then you really have to own physical gold because it's so extremely undervalued.
You've been in the gold market for a long time, and your website's goldmoney.com. I want to talk about goldmoney.com and Bitcoin merging, bitcoin.com. But hold on just a minute. We're going to talk about that. But have you ever seen the backwardation in all your years of being in the gold market? Have you ever seen backwardation, the spot price being higher than the future price? Have you ever seen it go on for this long?
No, never. And, I'm a student of monetary history as well. I've never seen it happen in monetary history because typically when a backwardation would occur under the classical gold standard, for example, the banks that had fractional reserve banking would go under and there would be a banking collapse. So typically if there is a backwardation that only lasts for a few days like it did in 1999 and 2008. So we have an unusual situation, and it's basically heavy government involvement in trying to keep the gold price under wraps so that it can maintain its policy of zero interest rates, thinking that they're going to jumpstart the economy. But the economy isn't being jumpstarted. All it's doing is deferring the ultimate collapse and the inability of governments to repay all of the debt that they owe.
But this isn't simply unusual. This has never happened in monetary history, the length, the amplitude of the backwardation. Is that right?
That's correct. In other words, just like we look back to the South Sea bubble and the Mississippi bubble, people are going to look back to today and say, gosh, this is the money bubble. People are using what they think is money, but is really a money substitute. And that's the theme of the book that John Rubino and I wrote, which is called The Money Bubble. We've lost sight of what money really is, and this is ultimately going to lead to a reconciliation of what money truly is. It's a physical asset without counterparty risk, gold and silver.
And this backwardation, I just want to get this down. This is historic. This has never happened for this long of a time in your mental history, your own personal history, but yet not only just that, but it's never happened in the history of gold. It's never been this long, the spot price higher than the future price ever in the history of gold.
I've never seen it. You're absolutely right. I've never seen it. This extremely unusual circumstance. It's a one-off circumstance. It's a bubble, in other words.
And you think it's going to pop, and it's sooner than later. We're getting to the end of the game here, aren't we?
Yeah, the money bubble is going to pop. It has to, because there's just too much debt in the world. That debt has to be reconciled. And ultimately, when you're reconciling debt, it gets back to your point about the collateral on the balance sheets. There's just not enough good collateral to support all of this paper money that's circulating out there.
And the premier collateral is going to be gold.
Absolutely. That's what you're going to want, and that's what's ultimately going to reemerge in terms of global commerce. It may not emerge in certain countries if the countries take a backward view and say, well, we're going to continue to force fiat currency into circulation. I mean, look at Brazil. How many times has their currency collapsed, but they come back with yet another paper product? But in terms of global commerce, the countries interacting with one another, multinational companies doing payments and interacting with other multinational companies, it's ultimately going to go back to gold.
And therefore, you also have a company, goldmoney.com, and then you have recently merged with bitgold.com. Tell me briefly about Bitgold. It's based on Bitcoin, is that right?
No, it's not.
Oh.
Bit is sort of a generic term for speed in the internet, and it's a way of moving gold around very, very quickly and using gold as a form of payment. It's a digital gold currency. That's what Bitgold is all about. And it's actually growing very, very rapidly. The merger, we announced it in May. It was completed just a couple of weeks ago. BitGold Inc., which was the company that merged with Gold Money, has changed its name now to Gold Money Inc., but it's still the same ticker symbol in Toronto, XAU. But they just released their performance numbers for July, and they had 100,000 new accounts opened in the month of July. So it's becoming one of the world's fastest growing financial service companies.
And they're going to have a credit card or a computer login, or how does it actually, do you go with your BitGold credit card and swipe it and pay in some increment of gold?
Yeah, I've already got the beta MasterCard where I could actually go and spend gold. But you can also spend gold just by clicking it from your computer to somebody else's computer, and very soon, it's in beta as well, you'll be able to click gold from your mobile phone to someone else's mobile phone and make a payment that way.
and somewhere somebody is holding on to this gold, not like GLD or SOV or
No,
they actually.
it's the same. Yeah, exactly. It's the same standards that we developed in Gold Money ourselves. It's one of the things I learned in banking many years ago when I was trained as a banker back in the 1960s. You actually want to have your gold safe and secure, and gold is all stored in companies that are in the business of storing. Brinks and others. It's not in banks, because banks are in the business of lending. They're not in the business of storing. So I never recommend storing gold in banks. I always recommend storing gold in companies that are professional storage companies.
Like Matterhorn Asset Management, Von Greyer, Egon Von Greyer's company. He's the storage company.
Yeah, Egon and I see things pretty much the same way, and I know he has similar standards to what we developed in Gold Money in terms of safety and security for one's assets, one's physical gold and silver assets.
All right, more information about this. I'll put your links up, your goldmoney.com and bitgold.com. We'll put those links up so people can get more information on both companies. James Turk, thank you for joining us today on usawatchdog.com. Thanks for the gold primer. We really appreciate it.
Thank you very much, Greg.